Hello, Accounting Superstars. This is Professor Don Bush from the Accounting Superstar YouTube channel. I've been a CPA for about 30 years and a professor for about that long, and I've got great ways to explain accounting, so welcome aboard. So today's lesson is about the operating cycle, and this lesson is designed for students who are in about their 5th or 6th week of their very first accounting class. So I'll explain the operating cycle to you, and I'll explain it in a very easy to understand way. We will not make it complicated or anything. We'll toss out all the unnecessary things just so you can get the idea. And then what we'll do is we'll learn how to measure the operating cycle. Several years ago, I lived next door to a guy who owned a race car. He was a race car driver, and his car was really cool. Every now and then I'd go over and talk to him about his car, and he'd show me the transmission or whatever, and it was really interesting. And you probably know that if you have a tachometer in your car, that when you're driving down the freeway at about 65 miles an hour, your engine spins at about 2,000 RPM. So for every minute, your engine spins around 2,000 times, which is really, really fast. That's a lot of spinning. So I asked the race car driver, I said, well, when you're racing, how fast does your engine spin at? And he said his engine spins at 9,000 RPMs, which is incredible. And I said, well, what does that do for your racing? Why does it need to spin that fast? And he said it was very simple. The faster your engine spins, the faster you can go. And I thought, well, that makes total sense. That's easy. Now, businesses are very similar. The faster they can get their operating cycle going, the more money they can make. It's really just that easy. So it's interesting that we can measure the operating cycle. We can know how fast their engine is spinning, you might say. So here's the operating cycle. It's right down here. Let me bring that up. There we are. So I'll keep this very, very simple, very straightforward. Let's suppose that we have a retail store and they start out with cash, all right? Now, most businesses buy their inventory on account, but let's just pretend for a moment that they just pay cash for their inventory, just to make things super simple. So the business starts out with cash and they buy some inventory. So here's a fellow, looks like he's checking out some inventory, and there's shelves and shelves of boxes, and that's all the inventory. So this inventory usually sits on the shelves there for some time, maybe only a couple of days, maybe a couple of weeks, or even a couple of months. It depends on the business and the inventory. But eventually, that inventory is sold. So I have a sale sign down here. That's what that means. The inventory is sold to a customer. Now, the business, many businesses just collect cash right at that moment when the sale is made. But let's just assume here, just to keep things easy, that the business sells this inventory on account. So the customer owes the business some money. So the business will send out an invoice, and sometimes that might take a couple of days or a week or whatever, or even a month to send out an invoice. And during that time, the customer is not paid for that inventory yet, but it's called an account receivable. The customer owes the business some money. But eventually, if everything goes well, according to plan, that customer does pay, and this is turned back into cash. All right, so the business receives cash, hopefully a little bit more cash than what they started with. All right, and so this cycle goes round and round and round. Now, the faster this can go, the more money that the business can generate. So it's a good thing to try to get that operating cycle sped up. And there's a few tricks to do that. And those tricks are described in a more advanced accounting class. But we can measure this. So what we're going to do is we're going to measure how long it takes the accounts receivable to be collected. And we're also going to measure how long this inventory sits on the shelf, all right? So, and since I've got the accounts receivable on the left, I'll kind of keep it on the left here. And then since I got the inventory on the right, I'll just keep it on the right, just to keep things easy. Ladies and gentlemen, here in this section, what we'll do is we'll measure the operating cycle. It's really pretty easy. So here you go. This is what we'll do. We'll start over here with the receivables. We could start with the inventory. It doesn't matter, but we'll just start with the receivables. So here's what we need to do is we have essentially 3 steps, 1, 2, and 3. So let's do step number 1 first. So let's find our sales. Now, where can we find our sales? We can find the sales on the income statement. It's a financial statement. So what I'm going to do is I'm going to split the screen here so we can find the income statement and the amount of sales. Here we are. Now I've got on the income statement, I've got it highlighted just to make it easy. So here we go. We've got sales revenue right here. And what we're going to do is divide it by accounts receivable. So sales divided by accounts receivable equals the turnover. So where do you find accounts receivable? Well, I hope by the 5th week of your class here that you know accounts receivable is on the balance sheet, right? It's considered an asset. So let's go down to the balance sheet. And let's see what we have here. Accounts receivable, 85,000. So what I'm going to do, and I already did this on Excel just to make the lesson a little easier and faster, is I'm going to take my sales revenue, 1,354,400, and divide it by accounts receivable, 85,000. Now, if you do the math, if you do that division, here's what you get. You get 16. Now, I know some people carry this out to like 15 decimal places. I never do that. I never feel it's worth it. I just round it off. So I rounded it off to 16. All right, so let's go down and let's drop down to the days in receivables. So here we are. So here's step number 2. All we're going to do is ask ourselves, well, how many days are there in a year? And there's 365 days in a year. And what we'll do is we'll take 365 and divide it by that receivables turnover, which is 16. So 365 divided by 16. And if you do the math, here's what you get. You get 23 days. And again, I know some people take this out to like 15 decimal places, and I never do that. Accounting in a lot of cases is not that exact of a science, so you don't need to carry out a lot of decimal places. So 23 days. So what I'm going to do is I'm going to drop that down into my last slot here, the operating cycle. I'm going to put it right here and just hold on to it for a minute. All right. Now let's go over here to the inventory. So step number 1 with the inventory, cost of goods sold divided by inventory. So let's find cost of goods sold. And you might be wondering, well, where do you find cost of goods sold? Well, it's on the financial statements, on the income statement, all right? On the income statement. So here we are, income statement. Cost of goods sold, 570,800. So you want to write that number down or remember it. 570,800, and we're going to divide that by inventory. So let's go down and find inventory, which is on the balance sheet. There it is, 95,600. So all we're going to do is divide those two numbers and we'll come up with a result. So here's what you get. The number 6. And again, you could have 15 decimal places. I've never seen a reason why to do that, but some people do. Okay, so we get the number 6, which means the inventory turns over 6 times a year. But let's turn it into a number that's a little easier to work with. Let's turn it into the number of days. That is the number of days it sits on your shelves and collects dust. So here's what we do. We take 365 days, which are the number of days in a year, and we divide it by that inventory turnover, which we have as 6, and here's what you get. You get 61 days. So on average, it takes 61 days for the business to sell its inventory. So let's drop it down into the last slot here. So here we go, 61. There we are. So here's how the cash works. It takes 23 days on average for the business to collect money, and its inventory sits on its shelves for an average of 61 days. So if you add the two together, you get 84 days. So what we're saying is this operating cycle takes 84 days. And you might say, well, so what? What's the big deal? Well, good managers will track this, and they'll find ways to shorten this operating cycle. And surprisingly, even if it's shortened just by a day or maybe even 2 days, makes a huge difference. Oh gosh, a huge difference in profitability and cash flow. It doesn't take much. So the one thing that you don't want is this operating cycle to get longer and longer and longer. That's usually not a good sign. So I hope this lesson helped you out. And if it did, please hit that like button, hit the subscribe button. I've got all these videos on accountingsuperstars.com, and they're all listed by topic. Really easy to find. So if you're looking for certain accounting topics, you might want to go to accountingsuperstars.com and find those videos. Anyways, until next time, over and out.